Chapter 3 is about adjusting journal entries. Before we get into actually what adjusting journal entries are, let's talk about where we stand in the overall process. As far as the overall process goes, what we worked on in Chapter 2 is we worked on journalizing, or preparing journal entries in the general journal. Oops. And everything that was recorded here really related to some sort of external transaction. What I mean by that is that something happened to make you go, oh, I need to do a journal entry. Whether a bill came in the mail, or you purchased some land, or you sold a piece of equipment, or you bought a piece of equipment, something external happened to make you go, hey, I need to prepare a journal entry. So when we prepared these journal entries, we prepared them in the general journal, and again, that was called journalizing. They all kind of work together that way. Now, the next step in the process was to, if you remember, it was to post those entries into the individual ledgers. So posting to ledgers was the next step in the process. So if you had a journal entry that adjusted cash, then you would adjust the cash ledger. If you had a journal entry that adjusted accounts receivable, you would adjust the accounts receivable ledger, and so on and so forth. Remember, every single account has its very own ledger, and in the ledgers is basically, the ledgers are like running totals of how much you would have in any account. So at any point, you should be able to pick up a cash ledger or an accounts receivables ledger and know exactly what the balance is in those accounts. Okay, so after you prepare the journal entries in the general journal and you post the ledgers, the next stop was the unadjusted trial balance. And the unadjusted trial balance, all it really would tell you is whether or not your debits equal your credits. The unadjusted trial balance takes all the balances of all the accounts in the ledgers and makes sure that all of my debits equal all of my credits. Now that's all it really does. It's kind of a first stop in the whole process to make sure there's no major glaring errors, like you didn't debit one account for $100 and credit another account for $1,000. So it catches that kind of error. But what it wouldn't catch is if you maybe debited land and you should have debited cash. That's not the kind of thing that's going to be caught through a trial balance. Okay, just to be aware of that. It's just basically the first step in the process. So after you prepare the journal entries in the general journal, after you post to the ledgers, after you prepare the unadjusted trial balance, this is where we are today. We're working on adjusting journal entries. And these are internal transactions. And I'll explain what I mean by that in just a few seconds. So we prepare the adjusting journal entries. And from there, after we prepare these journal entries, there is one more trial balance to do for now. There's even going to be a third trial balance at the end of Chapter 4. But for right now, we do adjusting journal entries. And after we do the adjusting journal entries, we have an adjusted trial balance. Oops, wrong spelling. Adjusted trial balance. Okay, so you get the idea here. You've done journal entries in the general ledger. You've posted to the journal entries in the general journal. You've posted to the individual ledgers. Then you have an unadjusted trial balance. You prepare adjusting entries, and then you have an adjusted trial balance. Okay, so now that you know where you are in this process, this is really the last two steps that are going to take us through the end of Chapter 3. Let me explain a little bit about why we prepare adjusting entries. As I mentioned, adjusting entries are internal transactions. So what that means is there's nothing that's going to happen. There's no bill that comes in the mail. There's no land that's purchased. There's no cash that's received. All right. Those are all, as I was mentioning, those are all the external transactions that we worked on through Chapter 2. Chapter 3 is about the internal transactions of a company. So adjusting journal entries are just things that you as the accountant need to know that you have to do at the end of the period. They're internal transactions. So at the end of every month is probably the most likely time frame. At the end of every month, what you would do is you would go, oh, certain accounts need to be adjusted. We'll go through in the second video here what accounts specifically need to be adjusted and how we go about adjusting them. But let me just talk a little bit first about the difference between cash-based accounting and accrual-based accounting. Adjusting journal entries are required by accrual-based accounting, and accrual-based accounting is what we're doing when we prepare these financial statements as an accountant. All right? Cash basis accounting is almost like how you live your life. And let me put you in a scenario. Let's say that you have to pay your car insurance and you have to pay it in January. And you pay $1,200 for car insurance. Okay, you may be saying to yourself as January approaches, ooh, I've got a pretty big bill coming in January. And you would pay that bill when January came, and then you wouldn't really think about it again for the rest of the year. You wouldn't think about it in February, March, April, May, June, and so on. You just know that you've got one pretty big bill that's coming in January. So that's cash basis accounting. You're really worried about when the cash is received, when you pay cash out, and so on and so forth. Now, accrual-based accounting, which is how accounting records are kept, is treated differently. So let's take that same $1,200 insurance payment. Okay, you have to pay car insurance on the car that's in your business. So you have to pay $1,200. Well, for accounting purposes, if you paid all of that money up front, it would actually be classified as a prepaid asset. What I mean by that is that $1,200 that you paid up front would actually equate to $120 every month, right? $1,200, or rather, oh wow, I just did that wrong. All right, let's try that again. $1,200 divided by 12 months would be $100 a month. There we go. So it would be $100 every single month. So from an accrual basis, what we would do is we would think about it as it cost us $1,200 for the entire year, and that means to us in the world of accrual-based accounting, $100 of insurance expense every single month. Because with accrual-based accounting, we don't care when the cash is received or the cash is paid. We care about when the expense is incurred. So that $1,200 that you paid in January is supposed to cover you from January through December, meaning every single month is basically $100 worth of expense. All right? So that's a little bit different than how you think about your own personal life and your own personal savings and spending. Accrual-based accounting is how all of our records are kept, and that's all about how we record revenues when they're earned and expenses when they're incurred, and we don't care about when cash is received. That's almost irrelevant to us. What we really care about is when you've earned the revenues, when you've recorded the expenses. And we're going to go through examples of 4 different types of adjusting journal entries that are all somewhat interrelated because they're all related to the revenues and the expenses. And we'll talk about one other 5th type that's also important. It's called depreciation, and it's a little bit different, but it is also considered an adjusting journal entry. All right, so come along with us to the next screencast.